Every free financial app on your phone knows your income, your spending patterns, your debt load, your savings rate, and your investment behavior. That is more detailed financial information than most people share with their own accountant. The app has it because you gave it access, and in almost every case, that data is the product the app is actually selling, packaged, shared, and monetized in ways described in a terms of service document you scrolled past in 4 seconds. Here is the business model most people never think about when they download a financial app. If you are not paying for the product, you are the product, and in the context of financial apps, that statement is more literally true than in almost any other category of free software. A budgeting app that connects to your bank accounts knows your exact income, your fixed expenses, your discretionary spending by category, your debt payment obligations, your savings rate, and your investment contributions. A credit monitoring app knows your credit score, your debt-to-income ratio, your outstanding balances, your payment history, and any inquiries on your credit file. A net worth tracker knows the combined value of every financial asset and liability you hold. Each of these apps asked for permission to access this information. You granted that permission when you agreed to the terms of service, a document averaging 11,000 words that the app presented at the moment of maximum enthusiasm, when you were most eager to see the dashboard and least likely to read the fine print about data sharing. None of the people who built these apps are doing anything technically illegal. The terms of service disclose what is happening. The problem is not concealment. It is the structure of consent, a document that requires a lawyer to interpret, presented at a moment of minimum attention, does not constitute informed consent in any meaningful sense of that phrase. It constitutes legal coverage. By the end of this video, you will understand exactly what free financial apps do with your data, who benefits from that data, how it is used in ways that can work against your financial interests, and how to evaluate which apps genuinely deliver value and which ones are extracting far more than they return. Let us start with how they actually make money. Free financial apps generate revenue through several mechanisms, and understanding each one changes how you think about what you are handing over when you connect your accounts. The first and most direct mechanism is financial product referrals. Most budgeting and credit monitoring apps have a built-in product marketplace, a section of the app that recommends credit cards, personal loans, savings accounts, refinancing options, or investment products tailored to your financial profile. When you click through and sign up for a recommended product, the app earns a referral commission from the financial institution. This is sometimes called lead generation, and it is the core revenue model for many of the most widely used financial apps. The recommendations are presented as personalized advice in your interest, and sometimes they genuinely are good matches, but they are always filtered through which financial institutions are paying the highest referral commissions at the time of the recommendation. The personalization is real, the neutrality is not. The second mechanism is data licensing. The aggregated, anonymized financial behavior data from millions of users is commercially valuable to financial institutions, advertisers, and market research firms who want to understand how people with specific financial profiles behave, what they buy, how they respond to financial stress, and what products they are likely to need next. Most apps' terms of service permit sharing of data in aggregated or anonymized form with third-party partners. The specific definition of anonymized varies significantly by company and jurisdiction, and research on data anonymization has repeatedly demonstrated that supposedly anonymized datasets can often be re-identified when combined with other available data. The third mechanism is premium subscriptions. Most free financial apps offer a paid tier with additional features, more detailed analytics, credit score monitoring updates, personalized coaching, or an ad-free experience. The free tier exists to build the user base and demonstrate value. The paid tier is where some portion of users converts. But even free tier users are generating value for the company through the first two mechanisms, which is why the free tier is genuinely functional rather than artificially limited. The fourth mechanism, present in some apps but not all, is direct data sales to financial institutions. Some apps have agreements with lenders, insurers, or other financial product providers that allow those institutions to use app data to inform their underwriting, pricing, or marketing decisions. This is the mechanism that moves from inconvenient to potentially harmful, because it means information you shared for the purpose of managing your budget may be used by a lender to assess your creditworthiness, by an insurer to price your policy, or by a marketing firm to target you with financial products at the precise moment your data suggests you are most financially vulnerable and most likely to need them. Now let us be specific about the depth of financial knowledge a connected financial app actually holds, and what can be inferred from it. When you connect a bank account to a budgeting app, the app receives access to your full transaction history, not just categories, the actual merchant names, transaction amounts, dates, and in some cases locations. From that transaction history alone, a sophisticated data analysis can infer your approximate household income, your employer, your rent or mortgage amount, your utilities, your recurring subscriptions, your grocery spending, your dining habits, your medical spending patterns, your travel frequency, your alcohol and tobacco spending, and whether you are regularly overdrafting or living near the edge of your account balance. From the pattern of transactions, when income arrives, how quickly it is spent, whether there is a consistent surplus or deficit each month, a financial profile emerges that is more detailed and more behaviorally accurate than what most people consciously know about their own finances. Now add credit monitoring data. A credit monitoring app that accesses your credit report sees your outstanding balances across all accounts, your credit utilization rate, your payment history, the age of your accounts, the number of recent inquiries, and any derogatory marks. Cross-referenced with your transaction data from the budgeting app, the combined picture is the most detailed financial profile of you that exists anywhere outside of a government tax return, and it is more current and more behaviorally specific than the tax return. Now, here is what makes this commercially significant. Financial profiles at this level of detail are extraordinarily valuable for financial product targeting. A lender who knows that a specific user profile is regularly running their account to near zero in the final days before payday, carries high credit card utilization, and has recently made several inquiries for refinancing, knows exactly what product to offer, at what moment, and what emotional state the user is likely to be in when the offer arrives. That is not general marketing. That is precision targeting using the user's own financial vulnerability as the trigger. This is the mechanism behind the personalized financial product offers that appear in many free financial apps at moments that feel uncannily well-timed. They are well-timed, not by coincidence, but by design, using data the user provided for an entirely different stated purpose. Now, consider what happens when multiple free apps share data through common third-party advertising and analytics platforms. A user who has connected their accounts to a budgeting app, a credit monitoring app, and an investment tracker has provided overlapping financial data to 3 separate companies, each with its own terms of service, each with its own data sharing agreements, and each potentially sharing data through common intermediaries. The intersection of those 3 data streams produces a financial profile more complete than any single app could build on its own. And the user, who thinks of these as 3 separate tools for 3 separate purposes, has no visibility into what the aggregated picture looks like, or who ultimately has access to it. The data economy operates at a level of aggregation and cross-referencing that individual consent decisions, made one app at a time, were never designed to address. If understanding what free financial apps actually know about you just changed how you think about the apps currently connected to your bank accounts, stay with me. Because the data collection and sharing is only one dimension of this. The specific ways that information is used to present financial products to you at the moments of maximum vulnerability, and how to evaluate which apps genuinely deliver value worth the data cost. That is what comes next. Here is the mechanism that moves from data collection to direct financial harm. When a financial app uses your behavioral data to present you with a financial product offer at a moment of identified financial stress, the offer is not designed around what is best for your long-term financial health. It is designed around what you are most likely to accept given your current emotional and financial state. Consider the timing of credit card offers in a budgeting app. A user whose transaction data shows they are consistently spending more than they earn in a given month is experiencing financial stress. That stress makes them more likely to consider a new credit card as a solution. A credit card offer presented at that moment, personalized with language that acknowledges their situation, is more likely to convert than the same offer presented during a month of positive cash flow. The app knows which month you are in. The financial institution that paid for the referral slot knows what offer to present. The timing is not a coincidence. It is the commercial value of the data you provided when you connected your accounts. Now consider the interest rate on that offer. The user who is under financial stress is also a higher credit risk. The credit card offer presented to them is likely to carry a higher interest rate than the offer that would be presented to a financially stable user. The precision targeting that makes the offer feel personalized is the same mechanism that ensures they are presented with the product that extracts the most from their specific situation, which is not the same as the product that would best serve their financial recovery. This is the core tension in the free financial app model. The apps that are most helpful at identifying financial stress are also the apps that are most valuable to financial institutions that want to reach financially stressed consumers. The tool that helps you understand your financial situation is simultaneously the tool that makes your financial situation legible and targetable to the institutions that profit from people in your situation. These two functions are not separable. They are the same product, serving two masters with different interests. Now, here is what makes this particularly difficult to navigate. The genuinely useful functionality is real. A well-designed budgeting app does help people understand their finances better. Credit monitoring does help people catch errors and track their credit health. The question is not whether the apps deliver any value. It is whether the value they deliver is proportionate to the data cost they impose. And that calculation is almost never presented to users in the clear terms that would allow them to make an informed decision at the moment of downloading. Here is the framework for evaluating whether a free financial app is worth the data cost it imposes. The first question is the revenue model. How does this app make money? If the answer is primarily financial product referrals, the recommendations inside the app have a structural conflict of interest you need to account for. If the answer is a paid subscription tier, and the free tier is a limited trial, the business model is cleaner. The company's revenue depends on delivering enough value that you pay, rather than on selling your data to third parties. If the app cannot clearly answer how it makes money, that answer itself is informative. The second question is data minimization. Does the app require full account connection to deliver its core function, or does it offer meaningful functionality with less access? An app that allows manual entry of transactions without bank connection delivers most of the budgeting value with a fraction of the data exposure. An app that requires full transaction history access to show you a net worth number is asking for more than the function requires. The third question is data portability and deletion. Can you export your data and delete your account completely? Apps that make deletion difficult or that retain your data after account closure are signaling that the data itself is the asset, not your subscription relationship. Proper data deletion should be available in 2 or 3 steps and should result in complete removal of your financial profile from their systems. The fourth question is whether you would pay for this if it costs $10 per month. If the answer is yes, the app is delivering genuine value, and the paid tier, if available, is probably the better deal than the free tier with data sharing. If the answer is no, the app is delivering convenience you value less than $10 per month, which means the data cost may well exceed the benefit you are receiving. The free financial app on your phone knows your income, your debts, your spending patterns, and your financial stress levels. That knowledge is the product it is selling, not to you, to the institutions that profit most from people in your specific financial situation. Understanding this does not mean deleting every financial app you own. It means evaluating each one with the question it was never designed to prompt. Is the value this delivers to me proportionate to the data I am providing in return? Now you have the framework to answer that question honestly. Share this with one person who has more free financial apps on their phone than they have thought about in the last 6 months. And if you want to keep understanding the systems built around your financial data, subscribe to Hidden Truth Files. Hidden, no more.